Welcome back to FT Markets. The Indian stock market has been on a turbocharged rally since Narendra Modi, the Prime Minister, won the election back in May. Speaking from Mumbai, we have the FT's Mumbai correspondent, James Crabtree, to try to shed some light on how sustainable this rally may be. James, thinking about the rally going on at the moment, how much is this due to the Modi phenomenon, and how sustainable do you think this might be in the coming months?
I think it's undeniable that Mr. Modi's victory in May had a huge impact on investor sentiment. Both foreign and domestic investors are very keen on the Prime Minister. They see him as business friendly with a can-do attitude, quite in contrast to India's previous government, which was seen to be weak and ineffectual and presiding over a long-term declining growth. However, over the first month or two of his government, the new Prime Minister hasn't done all that much. I mean, it's been a moderately disappointing performance given the expectations that were around when he did win power. However, the rally has been sustained by some more positive macroeconomic numbers and a general sense that corporate India as well, its earnings performance is improving. And so even though the government hasn't knocked it out of the park, the underlying data is beginning to creep up, and that has provided the market with another fillip over recent weeks.
And if we look at the more micro scale at one of the big corporates in India, Reliance Industries, what does that tell us about the ramp up after the May election and the subsequent fortunes of the big companies since then?
Well, if you look at the chart of Reliance's stock performance, it, along with a whole bunch of other large industrial companies, got a big boost after the election. Actually, Reliance isn't as close to Mr. Modi as you might think, and there are other large industrial conglomerates that have done even better. Part of the reason for that is that Reliance, in its particular case, has been waiting for the government to give it a gas price increase in its gas business, and the government hasn't done that for fear of looking like it was doing favours to its friends. So actually Reliance hasn't done quite as well out of Mr. Modi as it might have expected, but a whole bunch of other large industrial companies have done very well indeed and have even begun to raise equity again for the first time in a couple of years.
And thinking about the sustainability of the rally going forward, obviously one of the key metrics is the price-earnings ratio. What does that tell us about how long this could continue?
Well, the Indian PE ratio at the moment is roughly at about its long-term average, maybe slightly above, depending on which figures you look at. So if you're an India optimist, you would say, well, that looks all right, but actually compared to the real height of the Indian stock market in about 2007, 2008, at that point the price to earnings ratios were roughly double what they are now. So for the India bulls, as you call them here, they would look at that and say, actually, this has got a long way yet to go. Most of these companies haven't even really begun to see significant increases in their earnings. And so this rally can go on for a good long while. I think calmer voices might look at the performance of the government and think that actually what really matters is if Mr. Modi begins to deliver some of the long promised and much anticipated major structural economic reforms that India needs in areas like taxation and its labour market, and that without that it is perfectly possible that this rally could fizzle out in the not too distant future.
So the pressure's really on Modi to deliver on some of the reforms that he was talking about in the election campaign. But James, just thinking about the different sectors, it's very noticeable that some sectors have really outperformed others in this rally. We've got consumer durables rising well over 60% since the beginning of the year. Autos well over 40%. So what's happening here? Why are some of these sectors so obviously favored over others?
Well, I think if you look at the chart, as you say, consumer durables and autos, you have to start from the position that India's economy has been in a pretty miserable position for the last couple of years. People haven't been buying cars, they haven't been buying fridges, they haven't been buying washing machines because all the economic numbers have been going in the wrong direction and confidence has been low. And so what investors clearly believe is that after Mr. Modi's election, and given a cyclical upturn in the economy, people are going to start buying cars and washing machines again. The other sectors that have done well are things like public sector banks, heavy industrial groups, capital goods. They've also got a boost because they assume that the economy is going to turn around and Mr. Modi is going to bring in economic reforms. The ones that have prospered least well, although to be fair, everyone has done well because the market has been roaring at such a rate, as you said in your introduction, have been the safety stocks that investors flocked to over the last couple of years when things were bad. Those are IT outsourcing, consumer goods, in the sense of fast-moving consumer goods, and pharmaceuticals, and they've done rather less well over this period, but they, to be fair to them, had an absolutely tremendous run over the last 2 to 3 years when India's economy was in the tank.
Thank you very much, James. And so it seems that the Indian stock market, after this tremendous rally since the beginning of the year, is actually now back to around its long-term average in valuation terms. The question now is whether or not Narendra Modi, the Prime Minister, can really deliver on some of the reforms that he promised during the election campaign and which now India and stock investors around the world are waiting for.